Hi, everyone. Welcome to another educational video from Larson Wealth Management. My name is Roy Larson. I'm a certified financial planner, LPL branch manager, and president of Larson Wealth Management. And we specialize in what we like to call irreplaceable capital. And typically that applies to most of our clients who are retirees or within 5, 6, 7 years of retirement trying to get their ducks in a row, but really can apply to anybody who's received a large sum of money and realizes there's a lot of issues that go into making that money last a lifetime, whether it be taxes or investing or healthcare or estate strategies, and we work with them to get through all of those issues. Today's subject, we're going to be covering Social Security, and obviously this is a big subject, so we can't get into everything on this particular video, but there's a couple of key points I'd like to get into. One, we're going to concentrate on break-even analysis, and I'm going to give you what I think is going to be a useful tool in evaluating when the best time may be for you to start. And then I'm going to show you a couple of tips and some tactical strategies that most people aren't aware of. This is a question I would like to say we get a lot, but we don't get a lot on Social Security, and I'm not quite sure why. I think a lot of people just assume that taking it early is the best decision, and probably most often it is, quite frankly. Many of you will call the Social Security office and speak to a frontline person, and they are actually very well informed, and they give you good information, but the answer that you typically are going to get is, well, it takes 8 or 9 years to break even, and it makes sense to take it early, and I'm sure a lot of you have heard it before. I wish more of you would call me or your financial advisor on this, because even if the answer is to take it early, I would love you guys to do a little bit more due diligence on some of the possible combinations and make sure you are doing it the most efficient for you. But even if you do make some mistakes, I'm going to even show you how we may be able to fix those mistakes. So we're going to get into, again, break-even analysis in a few minutes. I'm going to show you a couple of key techniques. And yeah, this is a boring PowerPoint. I'm sorry, guys. I don't know any way to make this exciting. I won't be singing Sinatra during this video. I won't be telling jokes to liven it up a little. But what I can do is promise you I'll try and keep it brief. So let's jump right into it. And let's, I know most of you are aware of the basics, but let's just cover the basics really quickly before we jump into the calculator. Again, it is based on the highest 35 years of wages earned in the recipient's age of retirement. Some think it's the last 35 years, but it is the highest 35 years of wages. Benefits are adjusted periodically for inflation, and it is guaranteed to last the individual's lifetime or their spouse, whichever is longer. Obviously, most of us are cynical as to whether or not the federal government can maintain that guarantee, but obviously there's already a number of proposals to continue to make this a viable part of all of our retirement strategies. And also, a spouse working or not receives a benefit, which is the higher of either their benefit or 50% of their spouse's benefit. So your spouse does not have to have work experience. Again, full retirement age is at 66 now for people born between 43 and 54. The age gradually rises to 67 for those of us born at 1960 or later. I just make that cutoff. That's, I guess, not a good cutoff to be in. And the primary insurance amount, also known as the PIA, is the dollar amount a worker receives if he or she waits until full retirement age to start collecting. So again, for most folks, that's going to be age 66 or 67. At this point. How much is your PIA? Well, it depends, and it's really complicated to determine. There's a number of factors that go into it, but certainly Social Security website ssa.gov is the best place to go. There is a personal estimator at that site, and we also get those wonderful little annual statements out that I hope everybody is hanging on to. Also great information. When can I start? A worker may start retirement benefits at age 62 is the earliest, or you could use any month of entitlement, or MO. Like the financial industry, the federal government has come up with acronyms for everything. But you could choose any month of entitlement, or MO, up to age 70. And there is no advantage to waiting beyond 70. Benefits are not going to increase any further. So once you get to 70, if you haven't started by now, you're really just costing yourself some money if you wait any longer. Taxation and benefits. Most of you are aware of this, but if you make between 25 and 34,000, if you're filing as an individual in this case, you are going to be paying income tax on up to 50% of your benefits. And over 34,000, if you're filing individually, 85% may be taxable. We say may. For most of us, it will be taxable, but there are some reasons why it may not, and I'm going to send you back to the Social Security site for that. It's not really relevant to our presentation today. If you file a joint return between 32 and 44 at 50% and above 44,000 is probably going to be taxed at 85%. A lot of people are really confused on what counts as combined income. And one thing, especially those of you who love muni bonds, you're going to have to keep a track of this. It's basically three things that go into the hopper to determine what your combined income is going to be. First of all, your adjusted gross income. You're going to add to that 1/2 of your Social Security benefit. And you're going to add to that also your non-taxable interest, basically your municipal bonds. So be real careful. If you're working with an advisor and you are on the borderline of what you may be taxed, be very careful. Talk to your advisor about how much in muni bonds they are recommending, how much you are wanting, and how much income that is going to produce, because it could be the difference. It may be a non-factor. You may be so far over, but it very well could be a factor in putting you in one Social Security bracket or another. Working in Social Security, there are limits on earnings that apply to beneficiaries under full retirement age, and that's the key part of that, under full retirement age. So in 2012, if you're under full retirement age, again, typically 66 or 67, you can earn $14,640 without those benefits being penalized. If your earnings exceed this, then $1 in benefits is withheld for every $2 you earn above this limit. And I use the word penalized. That's probably not a good word to use, because you're not really penalized. They're going to hold the benefit back, and you are going to get it when you reach full retirement age. So keep that in mind. It's not something you lose, but it is something that may cause you to not want to apply for benefits early on, because if you are working, you may want those to accrue to a higher amount later on. If you attain full retirement age in 2012, you can earn $38,880 in the part of the year up until the month you attain full retirement age with no reduction in benefits. And if your earnings do exceed that $38,880, $1 in benefits are going to be withheld for every $3 earned above $38,880. But once you get to your full retirement month, you may work and earn as much as you like. There's not going to be any additional benefits withheld from you. Okay, we're going to come back to this. I want to go back. I want to take you to this calculator before we go into some of the strategic maneuvers. And there's a lot of good calculators out there. So you could use the one on the Social Security site. One of my colleagues came up with one that I really like a lot. And it's called sscalc.net. sscalc.net. And it allows us to go into a number of different scenarios. And I'm going to give you one scenario and walk you through a scenario now. But afterwards, go into it and put your own numbers and see what some of the combinations may be. It's pretty basic. It's not real fancy. It looks like there's some advertising there that probably helps pay for it. But let me just take you through the basic parts, and we're going to do an example. Obviously, make sure you check up here. I've run it a couple of times where I put in the numbers for the husband and wife and I forget to check married. So make sure you check married. You're going to put in your information. And let's just go ahead and fill that in right now in the interest of time. So let's say at full retirement age, let's make this person, let's call it August 15th, 1950. Okay. And a full retirement age, and these are all made up numbers, so I'm not sure what this per, obviously there's a lot of factors. But let's call it $1,500 a month at full retirement age. Now, if he takes it early, it's going to be reduced by how much? Questions from the audience? All right, nobody's answering. At age 62, it's going to be reduced by 25%. So that's going to be $1,125. And if you waited to age 70, it's actually going to increase by about 32%. So that's going to be $1,980. And let's put the spouse in. Let's have her a little younger. September 1st, we could leave that, and let's make her 1955. So full retirement age for her is going to be $1,200. If we reduce it by 25% for early, that's going to be $900. And if we increase it by about 32%, 1,584. Okay. Now, in this green box below, in this area, we see rates. So this advisor has already put in some of the basic rates. The COLA rate, which is what it's typically going to increase at. Historically, you could just click on it and see what he's using. So he's basing it on the last 12 annual increases. Inflation rate also at 2.6. And again, there is a rhyme and reason to that, but you can feel free to change that to whatever you like. If you are overly pessimistic as to what inflation is going to be, and most individuals usually are really pessimistic as to what inflation is going to be, you can certainly change that. And the investment rate. Okay, this is an important one. If you are planning on taking your Social Security because you need the income to live on, you're going to put a 0 in there. The reason why there's an investment rate in there, some people will say, well, you know what, I really don't need the money, but I wouldn't mind getting it because I think I can make more on it by investing it, gosh, even at 5 or 6%, than I would get in increases potentially down the road from the federal government. So again, this is going to be a personal preference, but if you are going to be using the money to live on, you want to put a 0 in there. If you are going to be investing the money, put a return. And don't be that guy from the 90s. Don't go putting in 25% a year because that's what you made in 1994 like the rest of us. You're going to invest the money in penny stocks. Don't be that guy or gal. Put in a normal rate. Keep it, based on where we're at these days. Something conservative, 5, 6, 7, and 8% if you want to see what it will do. So I'm going to leave it at 0% because in our example, we are going to use the money to live on, and we're going to compute the benefits. Let me show you what this does. This is very cool. Okay, and there we go. And this is going to show you in real dollars. You can also change the chart to net present value. But I'm going to leave it at a non-discounted rate or a chart of real dollars. And it doesn't allow for all of the combinations. You're going to have to do a little bit of work. But if you put in the correct information, it'll be easily attainable. In this case, they're showing it with both husband and wife choosing at exactly the same time and what the benefit would be. If you go down here, there are additional links where you can see it at different combinations. And the only thing I wish it would have done in the compare option side, let's go to it now. We can't really compare options for every possible combination. I can't poo-poo it on it too much since it's free, and he took the time to put this together. So I think he did a really great job with it. But this will at least give you a couple of combinations, and you may have to go back again if you're evaluating break even. Just pull the numbers from some of the other combinations. But let's say if we're even comparing options and we're trying to figure out, in this case, if we both took it early or if we both waited till full retirement age, where does break even fall? And in this case, We're still learning more. Taking it early, taking it early, taking it early. Where do we cross over? Right here. Age 84, one spouse, and 79 and other, where waiting till full retirement age would have ended up in more dollars. So real important in taking a look at those things, and why a lot of the times the answer is take it early. But you have to use your own circumstances. Is there longevity in your family? What is the life expectancy for both of you? Maybe your spouse is significantly younger than you are, and it would help her to get a larger figure down the line if you wait. Maybe you simply don't need the money, so you're going to wait and take it longer and play the odds that it may be a little bit more. So there really isn't any correct way to do it. All there are possible options, and obviously none of us know how long we're going to live. But certainly if there is not longevity in your family, if you're both of similar age, run the calculation, use this calculation, but it very may well determine that simply waiting until your 80s is not a good enough reason to wait to full retirement age. I'm going to take this slide down. I'm going to put the presentation back up, and I want to take you through some strategic maneuvers, and we'll wrap up in under a half hour. Couple of different maneuvers. One's called the DoOver we're going to cover. There's a second called restricted applications, and there's a third called file and suspend. So let's start with technique number one, the DoOver. And most of the Social Security information will tell you once you make that decision on taking benefits, it is a permanent decision. Well, is that actually the case? Not entirely. They do have a technique called the DoOver. You can file a form number 521. It's called for the request for withdrawal of application. And depending on how many years you've paid in, may determine whether or not this is a viable strategy for you. But basically, you would simply pay back whatever you have received to date, and you can reapply whenever you like at the higher level. So it's literally a do-over. It's as if it never happened. No interest and penalties, and even if your spouse is collecting on the same record, you'll get a step up in benefits when you reapply. And why would you do this? Well, it's probably going to be a couple of reasons. Maybe you did do a miscalculation. You didn't know about this wonderful sscalc.net, and you started a year later, you realized there were some better opportunities to wait down the road. Maybe you came in the money. You hit the lottery, you received an inheritance, you have all this money to live off of anymore, and you could kind of have your cake and eat it too and pay back the money that you now don't need from Social Security and get the maximum benefits down the road. There could be a number of reasons why you may want to do over. You may decide to go back to work, and it would certainly harm what benefit you're getting now, and you just decide to retool and reapply down the road. Again, no interest, no penalties. It's basically an interest-free loan. You just have to get them the principal back, and that is called the do-over. Second technique, restricted applications. Now, this technique is only available if both, we're going to assume you're married because that's where it would work best, but both clients have to have reached full retirement age. And the best way to demonstrate this example is just to illustrate a possible case. So in this example, the husband wants to keep working, but his wife wants to retire. The wife has earned enough credits on her own earnings record to file benefits, and she does so. Now, meanwhile, the working husband files what's called a restricted application to receive spousal benefits on her record. So he's not applying for his benefits yet. He is filing on hers. So she is a full retirement age. She's getting the benefits based on her working record. You are continuing to work, the spouse, the working husband. And again, keep in mind, because he's at full retirement age, those benefits are not going to be restricted, because once we get to full retirement age, we have no earnings limitations. The advantage to this is he can get some money from Social Security now based on her record or his record, and he can continue to work. And when he turns 70, he can then take the maximum possible. Beauty of this strategy is, at that time, his wife will have the option of taking the larger of her benefit, the one she's taking now, or half of his maximum benefit. And then what closes out this technique is, if she survives him, she is guaranteed to get the higher of the two for the rest of her life. So if you play these little nuances, it could end up being a little bit more money, and potentially over a lot of years, a lot of extra money in guaranteed income. So that's called the restricted application. Last technique that we're going to cover today is file and suspend. This one, you don't have to be at, both have to be at full retirement age, but one of you needs to be at full retirement age. So the working spouse is going to file at full retirement age, but then he's going to suspend the payments. So he's filed, but he's not going to get any checks. He's not going to have to pay any taxes on the earnings reductions assessed. And he's still going to get credits toward higher benefits. They will still actually accrue. So even though he's filed, he's not receiving anything. Well, why would you do this? It's going to allow the other spouse to apply for benefits on his record at age 62. Now, when the working spouse is ready to lift that suspension and take his own benefits, now the benefits are not only going to be paid at the higher level for him, but the spouse is going to get a raise as well. She's going to get a rise in benefits, and it's going to be at the higher level. So file and suspend. If one is at full retirement age and wants to continue working, suspends the payments, and the non-working spouse at age 62 is going to be able to take her benefits. Keep in mind, if she is working, that is still going to be subject to the earnings limitations, but a wonderful little technique. Which technique is going to be best for you? Well, it depends. There really is no one best technique, and quite frankly, none of these techniques may be best for you, but I think it's very important that you know some of the basic things that you are able to do. If you have any questions about this presentation, by all means, feel free to email me, call me at the number listed, or call your financial advisor. But this, I thought, was something that could be very helpful to people in just understanding some of the basics to a very complicated Social Security system. Again, there are a lot of nuances, but at least going into a very important income benefit for all of us, armed with facts and some of the tools available, I think are very important. So thanks so much. That's it for this presentation. By all means, give us a shout if we can help you in any way, and we'll see you next time. Take care.